bonds don't carry the return potential of equities, they really serve two purposes in your portfolio. The first is a steady and reliable stream of income that can be both taxable or tax exempt. And the second is diversification. Since no single portfolio allocation is suitable for every situation, I think it's just understanding your potential risks that's really crucial. Consider this graph from the 1926 to the end of last year. If you were invested in a 100% stock portfolio, your average return over that time period is about 10%. Now, your range of returns is pretty wide, anywhere from positive 54% to negative 43%. Now, on the other end of the spectrum, if you were invested in a 100% bond portfolio over that same time period, your average return gets a lot smaller to about 5%, but so does your range of returns, as you can see from these bars. Now, I'm not suggesting that a 100% stock allocation is incorrect, but I think it's just important to recognize the potential for return volatility in your portfolio. And incorporating some bonds into your portfolio can help reduce that overall portfolio volatility. So let's look at a few noteworthy events in the past 25 years, like the tech bubble in the late 90s, or the financial crisis in 0809, and more recently, COVID. In each of those time periods, the initial decline in stocks was quite eye opening, while bonds remained generally resilient. Now, they generally also moved in the opposite direction of stocks. And it's during times like these that investors may need liquidity. And the bond market, in particular the government bonds, really offer the flexibility to trade positions easily, even amid high volatility in other markets.
So, John, over the past couple of years, investors have been comfortable holding a slightly higher allocation to cash, given money market fund rates have been pretty high. If the Federal Reserve is able to continue to bring down short-term rates like they are hoping they can, based on current expectations, how can investors manage through this to still have a positive experience in their overall bond portfolio?
Yeah, so cash has been king over the past few years. Now, our fixed income portfolios are constructed to fulfill the goals of our clients, even as short term rates decline. Now, to achieve this, the investors will typically align their time horizon with the duration or time to maturity of their bond investments. Now, someone saving for a short term goal might opt for a shorter duration bond portfolio, while those looking for income over a longer time horizon might choose a longer duration strategy. Now, it's also helpful to understand that fixed income securities are issued by various entities, including municipalities and corporations, and obviously the US government. Now, within these different sectors, each issuer has varying levels of credit risk, impacting yield and ultimately return. So it's really your time to maturity, your sectors, and your credit quality that form the fundamental elements of a fixed income strategy. And together they influence risk, return, and overall performance.
And John, how does the team work together as they're managing these fixed income portfolios?
So at Bartlett, we manage fixed income portfolios for both private clients as well as institutions. We have an in house fixed income team comprised of four portfolio managers and three traders. And on average, we have about 25 years in the industry. So you could say we've seen a few different market cycles. Now, the team actively manages a range of strategies, collaborating with our advisors and our planners to create tailored portfolios that meet our clients' needs. For the tax sensitive investor, we offer several municipal focused strategies, each with varying degrees of interest rate risk. With the municipal focus, clients in this strategy tend to be individuals or families, and often this can be used as a tax management tool. Now, we also offer a corporate focused set of strategies. And the typical client here might be your non for profit, endowments and foundations, or even the low or non taxable accounts. Some of you in the audience today may serve on a committee or a board of an organization that could also benefit here. But all of our strategies here at Bartlett are designed to benefit a range of clients by providing tailored solutions that align with your unique financial goals.